Alright, so this video we are going to talk about the Federal Reserve. We already talked about how the Federal Reserve is the central bank of the U.S. So they are kind of the big bank for all the little banks. And in addition to that, so they're basically going to be lending money and holding money for the little guys. Now, in addition to being the banker's bank, they also print the money. So remember, they get to control how much money to print. So today we're going to look at how they get this money into the economy. So I'm going to figure out how we get the money into the hands of all the people who would like that money. And remember, we're not talking about wealth, we're talking about liquidity. So just keep that in mind as we're rolling through this. So the actions of the Federal Reserve are called monetary policy. And monetary policy basically says how we decide how much money we're going to have in the economy. So we're going to look at how does the Federal Reserve change the money supply. So they have three different tools. They've got their open market operations. They can change their reserve requirement, or they can lend. They can also lend money to banks through the discount window, and they can change how they go about doing that or how much they charge. So the biggest one of these, the most important one, is going to be our open market operations. So open market operations are generally buying and selling bonds on the open market. So with open market operations, you can either have expansionary open market operations or contractionary open market operations. Expansionary operations increase the money supply, whereas contractionary open market operations decrease the money supply. So with expansionary OMOs, we increase the money supply by buying bonds, and for contractionary, we decrease the money supply by selling bonds. So here we have the Fed. They can buy bonds to increase the money supply or sell bonds to decrease the money supply. So let's look at an example of an expansionary open market operation. So let's say that the Fed buys $10,000. They buy a $10,000 bond from an individual, and she takes that $10,000 and puts the money in her bank. So first, where does that money come from? Remember, the Fed gets to print that money. So the money is printed, and the Fed says, here, have some money, and I'll trade you that bond. So let's look at the balance sheets of each of those, each of the players in this operation. Okay, so for the Fed's balance sheet, remember we're going to have our change in assets and our change in liabilities. Now, what are the assets of the Fed? Remember, they can hold bonds, they can hold gold, other things like that. In this case, the change is in bonds. And we see a change of positive $10,000. But what about those liabilities? What are the liabilities in this case? Remember how each dollar bill says Federal Reserve note? They're responsible for that. That's a liability for the Fed. So any money that they produce is considered a liability. So when they give out $10,000 to buy a bond, then we have to count that as a increase in the liability from cash. So remember, what's our net change? Our net worth, or rather our change in net worth, is still equal to 0. Okay, so that's the Fed's balance sheet. What about the individual's balance sheet? So here we have her change in assets and her change in liabilities. What's her change in assets? So she had bonds. She was holding on to bonds, probably treasury bonds, And now she's sold them to the Fed. So she changes her bonds. That decreases by 10K. And now she also has $10,000 in cash, but then she puts that in the bank account. So let's go ahead and just say that she has increased her checking deposits by positive 10,000. Okay, and her liabilities haven't changed at all. So we see her total change in net worth is equal to 0. And is our banks. So we see their change in assets, change in liabilities, and so we see when our individual puts the money in her bank, we're going to see an increase in the bank reserves. We can think that she just showed up with $10,000 of cash, and the bank has not yet had a chance to loan that money out. So we see an increase of the reserves of $10,000. And then we also see an increase in the liabilities. So we have checking deposits. We're also going to increase by $10,000. Once again, net worth, change in net worth, still equal to $0. Okay, so now we've looked at all the balance sheets. Now, what does this look like? It looks a lot like the first step, because we know that this bank is not just going to hold these reserves and not make any money off of them. Their liabilities have increased by $10,000. Reserves have also increased by $10,000. They don't have to hold all of that. They can loan some of that out. So we're going to see that multiply. So what do we have? So this was an expansionary open market operation. Remember, the Fed printed some money and they bought a bond or a series of bonds from an individual. So we traded, the Fed gave out some money and pulled back and now is holding on to some bonds. And then we can see those effects ricochet. But so we see our net worth has not changed for anybody. And our money supply has increased. So far, before the bank has a chance to let the fractional reserve banking system go to work, we've only seen a $10,000 increase in the money supply. But we know that the story. But we need to think about how the fact that now the Fed has more bonds and they have more cash liabilities. So we want to think that this cash is floating out in the economy, and we don't know where it is. It can be going anywhere, but we know that the Fed has more liabilities. Okay, so how much does this $10,000 bond purchase, our open market operation? How much does this change the money supply? So here we go back to our equation that we had before. It's going to be a little bit, I'm going to abbreviate because it's difficult to write with this program. So we're going to have the change in the money supply, MS, is equal to the change in total deposits plus the change in cash held by the public. Okay, I have to go back on this. So anyways, so we're changing the money supply. The total deposits, remember that she took, we did get cash from the Federal Reserve, but she's just put it into her bank account. So we just see this change in the money supply is going to just be our change in total deposits. So remember we had $10,000, and then we're going to have to multiply it times our money multiplier, which let's assume is still just that 10% reserve. So we see the total change is $100,000. Sorry for the sloppiness. So remember, we've got, this is our total change. Now, the key difference here between this case with the open market operation and the earlier case when we just saw someone took $10,000 out of their pocket and deposited it in a banking account is that this change in cash held by the public, in the case when you take cash out of your pocket and put it in the bank, we see a change in the cash held by the public. When we sell a bond to the Federal Reserve, we put that money directly into a banking account, and we that full amount is counted as a change in the money supply. And of course, you can think through a scenario where maybe she didn't put all of the money directly in the bank account, maybe she spent some of it, but eventually it's going to end up in deposits. The key is that the source did not come from the public. So the source was not the public, it was the Fed. Okay, so now let's do an example of a contractionary open market operation. Let's say that the Fed sells a $10,000 bond to an individual. So when they sell this bond, before they had some bonds in their assets, and excuse me, and so they sell the bonds to the individual and take money for in exchange. Now, when the Fed has money, has cash, it's no longer circulating in the economy. So once the money goes back into the Fed, we don't consider it part of the money supply. So it's not part of our money supply. Okay, so what do we see? Let's look at the balance sheets once again. So with the Fed's balance sheet, let's have our change in assets and our change in liabilities. So if they have just sold a bond, $10,000 worth of bonds, then what's happened to their assets? Their assets held as bonds have decreased by $10,000. And what about their liabilities? Remember, the cash in circulation was a liability, but the cash held by the Fed is no longer a liability. In some sense, you could almost even think as that cash goes into the shredder. They're no longer it's no longer in circulation. So we're going to decrease the amount of cash liabilities that they hold. And what do we see? Change in net worth of 0. Now if you look at the individual's balance sheet, you can probably guess what's going to happen here. Change in assets, change in liabilities. We'll look at the balance sheet. So remember, the Fed just sold a bond to the individual. And we're going to assume that they take that money out of their checking account to buy that bond. So first of all, we know that the bonds, assets held as bonds, are going to increase by $10,000. But assets held as deposits are going to decrease by $10,000. We don't see any change to their liabilities, so their change in net worth balances out, and it's just 0. So the bank's balance sheet, we've got our change in assets and our change in liabilities. And what do we see? Because the individual took $10,000 out of her banking account, on the bank side, we see a change in reserves, and we see that change is negative $10,000. Okay, so now we see a change in reserves by negative $10,000. You can kind of start thinking what's going to happen already. And of course, because they have $10,000 less in their checking account, our woman who bought the bond, their liabilities also go down. The bank's liabilities also go down. Deposits are going to be negative $10,000 as well. Once again, our change in net worth is still 0. So no one has changed net worth, neither the Fed, nor the individual, nor the bank, except there's been a decrease in the amount of cash flowing through the economy. So if you think about, this is going to set the reverse multiplier process into action. And we can ask, how much does that $10,000 bond sale change the money supply? So we can think of the total effect on deposits, and then the total effect on the money supply. So let's just do that together. So we've got the change in the money supply is equal to the change in total deposits plus the change in cash held by the public. Okay, so what do we see in our change in total deposits? Remember, once again, we have our initial deposit times our money multiplier. So our initial deposit was $10,000. And then we multiply that times our money multiplier. In this case, we're still going to assume just a 10% required reserve with no excess reserves. If we have excess reserves, then this number here is going to get bigger. And what do we see in terms of our change in the cash held by the public? Once again, we don't see a change at all. So before we had $10,000 in a banking account. Now the Fed has taken that out of circulation. So the only thing that has changed is the deposits and not the cash. So our change in deposits is going to be equal to 0. So then we take our money multiplier effect, and the total change is going to be $100,000. So that one contractionary open market operation of that $10,000 bond sale has changed the total money supply by negative $100,000. So remember, this is a contractionary open market operation. The Fed is selling bonds and taking back cash. So let's take a minute and look at other tools of the Fed. First of all, we'll look at reserve requirements. Remember that the required reserve is an important determinant of the money multiplier. We want to ask, what is the impact of reducing the reserve requirement on the money multiplier? We could also increase the reserve requirement, but it would just be the opposite. So if we reduce the reserve requirement, then we're going to end up, remember, our money multiplier is equal to 1 over our required reserve plus our excess reserve. So if we reduce our required reserve and we assume that that doesn't have an impact on excess reserve, then it is going to increase our money multiplier. So imagining if the reserve requirement goes from 0.1 to 0.5, I'm sorry, 0.05, then the money multiplier is going to go up accordingly. Turns out we don't change the reserve requirement very much. The last change was in April 1992. So another tool is of the Fed is that they lend to banks at what they call the discount window. Now the Fed lends money to meet, so banks can meet their reserve requirements. This is usually a really short-term loan, oftentimes overnight. The rate of interest that they charge is called the discount rate. Now remember, this is not the same as the discount rate for present discounted value. This is just the rate at which they charge for loans. So now, what could they change? If they change the cost of lending at the discount window, then it makes an impact on that cost-benefit trade-off of keeping excess reserves. Remember, the reason why we keep excess reserves is because The reason why banks might keep excess reserves is because it might be costly to borrow short-term money if they need to meet further withdrawals, like greater withdrawals than they're used to. So you can, if they lower the discount rate, then it becomes less costly to borrow, and it's less likely, and banks are less likely to keep excess reserves. These are supposed to be little arrows. So this is just a chain of reasoning. So there's two ways that the Fed can use this tool. They can either change the discount rate, or they can change the limit on how much banks can borrow at a given discount rate. For example, during the crisis, they brought the discount rate almost down to zero, and due to the amazing disaster of the financial system at the time, it really didn't even help that much. So this is a limited tool, but under normal circumstances, it would have an impact. So one other thing, the federal funds market is a different thing from the discount window lending. Banks can also borrow from each other to meet their reserve requirements. And the rate that they charge is called the federal funds rate. These are really short-term loans as well, often overnight. And just one thing to remember is that bank-to-bank lending does not increase reserves in the system as a whole. So remember, it's the average reserve that matters. So if they're borrowing from each other's excess reserves, it doesn't change the amount of overall reserves. So this doesn't have an impact on the maximum M1 money supply. And the last point is there's been a change in the policy of paying interest on bank reserve balances that are held at the Fed. So as of 2008, the Fed now pays interest on the bank reserve balances. So check out on your own in the news box in the textbook called the Fed's Exit Strategy, as well as the Bernanke speech in the additional reading. And you'll see how this interest on the bank reserve balances is now another tool in their toolbox to be able to impact the behavior of banks and thus the level of money in the economy. All right, thanks so much for listening, and that'll wrap it up for the Federal Reserve.